I thought we were going to get like a 35% correction in silver at this point. As we move into this next leg up and get over $100 again, I think that run from 100 to say $200, because I do think my 180 is going to prove low. I think in there you will see a lot more institutional buying as part of that run up. I have a long-term forecast of $1,000, but that's out early 2030s. Let's say gold does up. I'll round the number off because I think I'm probably going to be proven conservative anyway. So let's say we get 7,000, you get a 50% correction, takes you back down to, 3,500. From there, you could see 20,000 in gold by the early 2030s, and the miners obviously have leverage to that. So there's another opportunity after this one. And frankly, I don't think a lot of central bankers or policymakers realize that there is a bust coming. They think 2008-9 was kind of the big one, and they may worry about a downturn, et cetera. But I think they're buying gold primarily because of all the debt.
A lot of people. First, I should ask your metals outlook. I know that you were talking $6,800 gold, 180 for silver, but we saw that slight correction take place. I've been talking to a lot of people. A lot of them just describe it as froth coming out of the system. It went a little bit too high, too fast. What was your thoughts on that correction?
Yeah, well, if you're talking about the whole correction, it really went a lot more than a little high. It went from 50 to 120 in a matter of weeks.
Yeah.
That obviously needed to get corrected. It was a parabolic run. Normally, parabolic runs are end of cycle runs or things that you kind of say, hey, maybe that was it. In this case, didn't wait very long. It didn't cause me a lot of consternation in terms of, hey, is this the top? I just said, yeah, we need to correct. I thought we were going to get like a 35% correction in silver. It went down 50% in that initial sell-off, and we've been kind of back and forth in a consolidation ever since for the last couple months. I think we're pretty well done with that. I think we did consolidate that huge run, and I think we're poised for the next leg up, which will be, again, parabolic, probably even steeper than that one, or certainly similar. That's how I get to 180.
Right.
And I'm not so sure that I'm not too conservative still.
Yeah, interesting. I mean, silver especially has a history of violent blow-offs, but if it runs to 180 quickly...
Parabolic rallies usually get celebrated right before they punish late buyers. David Hunter notes a move from $50 to $120 in weeks may look bullish, but violent corrections often expose how thin conviction really is beneath momentum. A 50% silver drawdown is not froth if leveraged money is driving price faster than physical demand. For wealth protection, this is where chasing breakout headlines can quietly become portfolio damage. Next, David Hunter reveals whether this setup is accumulation or another dangerous blow-off trap.
Why shouldn't investors treat that as an end-of-cycle warning rather than kind of a new secular beginning?
Well, I have a long-term forecast of $1,000, but that's out early 2030s, and because of the bust, I do believe this thing, wherever it goes, whether it's 180 or whether it's Michael Oliver's number of 300 to 500, I think it'll have a blow-off run here this year. Like I said, it could happen by Labor Day. It might take into the fall. But I'm not so worried about the number. My 180 is where I could get to on my work, but I don't discount the fact that it could blow right through that in a blow off and take you up to 250 or higher.
Right.
So I would not use that number per se as much as to realize we're in I think a late stage for this cyclical cycle. For this cycle where we're I don't think we go beyond this year. And then because of the bust, pretty much all assets other than treasuries will go down.
Right.
Silver is very volatile, so that could go down, 50, 60, 70%. Gold probably less so, maybe 30 or 40%, but it could go 50 and this go 75. So there is a downside, I think, because of a global bust. If I'm wrong about the bust, maybe it lasts longer, but I think you've got some kind of a cycle end here.
Late cycle surges often look strongest right before liquidity disappears. According to David Hunter, the real issue is not whether silver hits $180 or blows through it, but whether investors mistake peak momentum for durable safety. When forecasts include both explosive upside and 50 to 70% downside, timing becomes more important than price targets. Savers who hear only the upside narrative may ignore how fast cyclical reversals erase years of gains. Next, David Hunter exposes why a bullish breakout can still signal structural fragility.
This year, and obviously I think it's going to be a violent one. So that's why I am thinking this is very late in terms of that move. We've come a long way from, silver down at $20, up to 120, and in this case probably up to 180, $200. So it's to me it's we're months away from a point where you have to make that decision, not years.
So you still got a little bit of time. I mean, obviously you're talking about that cycle kind of targeting $6,800 for gold as well. In this one, on our community poll, one of our viewers, Damad77, asked about the exact reaction of these metals when the recession kind of actually hits. I mean, do these targets happen before the 80% market wipeout, or are they kind of a product of the recovery on the other side?
Yeah, no, these are definitely targets prior to the bust and prior to the bear market. Well, like I said, it could happen before Labor Day for both gold and silver and for the stock market, but it doesn't have to. It could carry. We might even see it carry as far as the election or come close. So I'm not so worried about pinpointing that, but it's definitely pre-bust, and then you get that correction in the bust. And that should present a generational opportunity, because if, let's say, gold does up, I'll round the number off because I think I'm probably going to be proven conservative anyway.
The biggest risk is assuming time is on your side, when markets may be months from reversal. What David Hunter is highlighting is that these upside targets are pre-bust, meaning gains could arrive before broader destruction resets valuations. That matters because many investors confuse long-term bullishness with short-term safety. If metals spike while equities weaken, allocation discipline matters more than emotional conviction. Next, David Hunter unravels why a massive correction could become the real entry point, not the rally itself.
So let's say we get 7,000, you get a 50% correction, takes you back down to 3,500. From there, you could see 20,000 in gold by the early 2030s. So, and the miners obviously have leverage to that. So there's another opportunity after this one, but this one still is far from over. There's a big run here.
Yeah, it's been wild to watch. I mean, at least on this side of the camera covering it. And I mean, historically, specifically, I guess in 2008, in 2020, precious metals crashed initially because institutions had to liquidate winning positions to cover margin calls. But physical holders don't face that same forced liquidation risk. Separate the vehicles for us here, if you would. Physical metal, ETFs, futures, and miners. I mean, which ones survived that initial leverage unwind? And does the system kind of break down to the point where, only, I guess, physical metal protects capital?
Yeah, well, physical certainly will be the more stable, and obviously supply demand, particularly with sovereigns being so interested in it, helps hold that up. I'm sure it will, trade down with the paper at some point. It's not going to deviate that much that it goes opposite. But it will be more stable and will probably come down slower. The ETFs, we saw this, back in 2020. We saw this in 2008-9, I think. But certainly I remember 2020. You have two things going on then. You have the underlying securities in that ETF under pressure, and then you have all those.
A rising gold price does not mean every gold exposure protects you equally. David Hunter's argument suggests physical metal may hold firmer than ETFs or miners when forced liquidation hits, because institutional selling can distort paper vehicles faster than fundamentals. That contradiction matters because retail often hears gold is safe without understanding vehicle-specific risk. In sharp downturns, structure, not story, determines who preserves capital. Next, David Hunter reveals why paper exposure can crack before the underlying thesis does.
Particularly, we found out how much institutions use the ETFs. You have the liquidity problem of some big whales wanting to get out and get out in a hurry, and so the ETFs actually went down farther and faster than did the underlying miners that were in the portfolio. So that is a risk that I think you see anytime you have a big downturn. And the miners themselves obviously have plenty of volatility and plenty of risk if the metals roll over. So it's pick your poison. They're all going down, I think. Obviously physical less so, or less fast. But I think they're all going to get hit pretty hard. Not nearly, except maybe silver, not nearly as hard as equities themselves.
Right. Yeah. I mean, to that point, you're talking that 50% correction in gold, possibly to kind of pick up that haircut and kind of get back in. And miners, obviously, that kind of correction would be brutal, and miners would be hit first. If miners have leverage to the upside, obviously they have leverage to the downside. How do investors avoid getting wiped out before the real 2030s opportunity arrives?
Well, two things. One, if you're investing without leverage, your own leverage, if you're buying stocks, you can hold on. You may not like the volatility in the portfolio valuation, but you can hold on. If you're leveraged, you could get wiped out. So, I would say be cautious as you get closer to at least my idea of what the top is, and because once it goes over the other side of the mountain.
The same asset praised for upside leverage can become the fastest destroyer of capital on the way down. This is where David Hunter's thesis shifts from opportunity to survival, because ETF liquidity stress and minor volatility expose how quickly leverage punishes bad timing. Wall Street often sells upside participation, but says far less about downside mechanics during panic exits. For ordinary investors, avoiding wipeout can matter more than catching the exact peak. Next, David Hunter exposes why leverage turns conviction into forced surrender.
It can unwind pretty fast, and if you have leverage, you're going to get wiped out.
Yeah. Speaking of moving fast, the gold market structural changes have been quite stunning. Last year going into this year, and this morning I saw Goldman Sachs just projected central banks will step up gold buying to an average 60 tons a month through 2026 in one report. And then at the same time, just this morning, Hong Kong's launching a new gold clearing system in July to offer an alternative to London. David, are sovereign institutions accumulating physical gold right now to front run the deflationary bust that you're forecasting, or are they strictly preparing for that monetary reset that comes after it?
Yeah, I think it's more. And frankly, I don't think a lot of central bankers or policymakers realize that there is a bust coming. I don't think if you talk to them, they have any idea that that's what's coming. They think 2008-9 was kind of the big one, and nothing like that's coming again. So they may worry about a downturn, et cetera. But I think they're buying gold primarily because of all the debt and money that has been put out there over since 2008, and particularly since 2020. I think people realize that fiat currencies are not the sound money story today. And obviously we have things like the BRICS, looking to try to create a gold-backed currency, and right. China I think understands maybe pretty well what's coming in the future. And they want gold. So I don't think it's because they're worried about a bust. They're more worried about fiat currency.
Central banks do not expand gold infrastructure this aggressively unless trust in currency systems is being quietly questioned. As David Hunter points out here, 60 tons a month in projected buying matters less as a bullish headline and more as a signal that sovereign behavior is diverging from public confidence in fiat stability. Hong Kong's clearing alternative also hints at strategic positioning beyond simple reserve management. For investors protecting purchasing power, policy language matters less than capital flow direction. Next, David Hunter exposes why gold accumulation may reflect monetary distrust before recession fear.
Yeah, I mean, central banks are building infrastructure, I guess alternative infrastructure to London, as I just mentioned there, in accumulating physical supply that could establish a stronger structural floor and limit the severity of a gold drawdown. Does sovereign wealth does it kind of act as a buyer of last resort? Does that change the crash narrative for gold at all?
It may. I don't think it will. I mean, just look at near term what we've seen in both gold and silver in just the last few months. So if it can do that, and when we're in a reasonably healthy economy, what happens in a bad economy, and what could be more than a bad economy? I just think sovereign may step away to some extent during that time. So I don't think so. I may be surprised by that, but I think you can, as I tell people, I think you can look at somewhere between, 35 and 50% downside in gold from a top, and probably 50 to 75% in silver. So, it may not be as bad as that, but I think that's what should be anticipated.
Yeah, you brought up that silver run up where it happens so fast. I mean, the $50 to $120. I mean, it feels like silver's already acting like a stress asset and a momentum asset at the same time. Is there a specific kind of signal that tells you that this move is institutional accumulation, not just funny? Well, I guess funny money, some would call it, but not just fast money speculation.
A stronger structural floor does not mean downside disappears when liquidity cracks. David Hunter notes that even with sovereign accumulation, gold could still face 35 to 50% downside, and silver much worse if macro stress forces broad selling. That breaks the comfortable narrative that institutional buyers automatically protect price. For long-term holders, owning hard assets is different from assuming they cannot sharply reprice under pressure. Next, David Hunter unravels why sovereign demand may not rescue markets when panic replaces strategy.
Yeah, I don't have any that can tell you that. I mean, I think it's both. Frankly, I don't think institutions have yet really warmed up to it.
Yeah,
it's been for the longest time. Gold was not even looked at as an important piece of portfolios until recently. And so then they say, oh, maybe you should have 5 to 10%, and some people 20% in gold. Silver, I think, is far less looked at as something that institutions need to have in their portfolios, or wealth managers have put in portfolios. What happens, I think, is momentum starts, attracting attention, and institutions start moving away from kind of stubbornness of saying, yeah, we don't need silver. It doesn't fit our parameters. And they start realizing that, it's a runaway freight train in terms of momentum, and that they should be on board. So as always, I think psychology plays a role both for retail and for institutions. But frankly, I don't think they've really, obviously there are institutions out there that are buying, but I don't think in main part there are all that many institutions that are really paying much attention to silver at this point.
Yeah.
I think as we move into this next leg up and get over $100 again, I think that run from $100 to say $200, because I do think my 180 is going to prove low. I think in there you will see a lot more institutional buying, and that's part of that run up.
I mean, we should talk about the retail investment demand as well as the industrial. I mean, at $180 an ounce, obviously the physical market changes drastically. Solar, EV, the electronics manufacturers operate under severe margin pressure already. I was looking at this report.
Momentum often attracts institutions only after the easy asymmetry is gone. According to David Hunter, silver still sits outside core portfolio thinking, which means future buying could be driven more by chasing price than disciplined conviction. That matters because institutional entry is not always smart money. It can become late money reacting to runaway momentum. If retail mistakes that for stable demand, volatility can hit harder than expected. Next, David Hunter reveals why psychology may drive silver faster than fundamentals.
When silver recently touched $90, it made up about 29% of the cost of a solar panel. We know it's not just solar panels made out of silver, but at double that price, physical demand could slow a little sharply. We could substitute, redesign, maybe copper. If industrial buyers pull back to save margins, does retail investment demand have enough volume to kind of sustain that 180 price tag on its own?
Yeah, as I say, I don't think it's just going to be retail. I think it's also going to be institutional.
Institutions.
I think the run from $100 to $200 is going to be dominated by speculation, by chasing momentum, far more than physical. So they will more than make up, I think, for any physical drop off.
Yeah,
and of course we know that on the physical side, a lot of that has already been purchased, and so it's really next year's contract that they are worried about. So at least between now and the end of this year, I'm sure the physical's pretty well already been priced. They've already priced their purchases.
Yeah, it's an interesting macro environment.
When speculation becomes the primary buyer, price can detach from real-world demand faster than most investors expect. What David Hunter is highlighting is that if silver climbs from industrial necessity into momentum trade territory, physical buyers may step back while speculative money temporarily fills the gap. That creates a fragile market where headlines look bullish, but durability becomes questionable. For savers, chasing price without understanding demand substitution can quietly magnify downside risk.